Every now and then, a property comes onto the market that looks like a fantastic deal. Maybe the price is unbelievably low, or it seems to have all the features you've been looking for. But here's a crucial real estate truth. The biggest risks in a property aren't always obvious. Sometimes, the most appealing houses are precisely the ones that carry the greatest hidden dangers to your long-term wealth. Most people look at a house and see four walls, a roof, and a price tag. Savvy investors and strategic homeowners, however, see a complex equation of present value versus future costs and potential liabilities. They ask, what makes this house so risky? And more importantly, are these risks worth the potential reward, or is this a wealth trap disguised as an opportunity? Today, we're diving deep into identifying those unseen risks that can turn a seemingly good deal into a financial nightmare, and how to protect yourself. The problem is that most buyers, whether first-time homeowners, seasoned investors, or families looking to upgrade, often overlook the subtle but significant factors that elevate a property's risk profile. They might be seduced by a low price, a stylish renovation, or the emotional appeal of a dream home. For a first-time home buyer, this can mean sinking their life savings into a money pit. For an investor, it could mean negative cash flow or a property that becomes impossible to sell without a significant loss. People relocating often rush their decisions, failing to research local nuances that introduce major risk. Even experienced landlords can miss critical details that lead to costly maintenance or tenant issues down the line. The common mistake is to evaluate a property in a vacuum, focusing solely on what's visible today, rather than what might unfold tomorrow due to intrinsic property issues or external market forces. The underlying principle here is that a property's true value and its long-term potential as a wealth-building asset is profoundly shaped by factors beyond its immediate appearance or even its current market price. Experienced buyers and investors understand that real estate isn't just about square footage and finishes. It's about the intersection of location, structural integrity, economic resilience, and regulatory environments. They approach every property with a mindset of critical scrutiny, always seeking to uncover potential vulnerabilities. They know that property with high intrinsic risk, perhaps due to an unusual location, specialized features, or a complex legal history, will likely demand more capital, time, and emotional energy over the long haul. This shifts the focus from how much does it cost to what will it truly cost me over time and what is its enduring value. To help you navigate this, we've developed the Property Risk Stack Framework. This isn't just a checklist. It's a systematic way to analyze a property's layered risks, from the broadest market forces down to the specific details of the structure. First, consider location and market risk in dotty. This includes everything from the broader economic health of the region, job growth, industry diversity, to micro-location factors like proximity to undesirable infrastructure, noisy highways, power lines, flood zones, crime rates, or even the potential for future development that could impact your view or quiet enjoyment. Is the local market overly dependent on a single industry? Are there impending zoning changes? Second, examine high property intrinsic risk data. This goes beyond a simple home inspection. Think about specialized, expensive-to-maintain features like an Olympic-sized pool in a cold climate, an incredibly steep driveway, or a custom-built home with non-standard parts. Are there signs of unpermitted work? Does the property have unique easements or shared access agreements that could lead to disputes? What about the health of the homeowners association? HOA, if applicable. High fees, pending lawsuits, or underfunded reserves are major red flags. Third, assess a financial and regulatory risk. This includes potential for unexpected insurance costs due to location, e.g., hurricane or earthquake zones, property taxes that are likely to skyrocket, or even the looming threat of rent control if you're an investor in certain areas. It also involves understanding the overall debt structure if you're taking over existing financing or facing unique lending requirements. Let's apply this framework with a realistic example. Meet Sarah, a first-time investor looking for her first rental property. She finds a charming historic 3-bedroom house, listed well below comparable properties in a desirable part of town. It looks like an absolute steal. However, applying the property risk stack framework reveals crucial insights. Location and market risk. While the neighborhood is generally good, this specific house is on a busy arterial road, creating significant noise pollution and making it less attractive to families with children. Furthermore, a new industrial park is planned just 2 blocks away, potentially increasing commercial traffic and noise, and changing the character of the immediate area. Future resale value could be negatively impacted. Property intrinsic risk. A professional inspection reveals that while structurally sound, the house is in a designated historic district, meaning any exterior renovations or major changes require approval from a historical review board, adding significant time and cost to future projects. Furthermore, a quick check of public records shows an easement granting a utility company perpetual access through the backyard for a buried pipeline, a detail not mentioned in the listing. And the charming Victorian features, while appealing, require specialized and expensive maintenance that Sarah hadn't budgeted for. Financial and regulatory risk due to its age and specific construction materials, insurance quotes come back significantly higher than expected. The local council has also been discussing new short-term rental regulations, which could impact Sarah's initial strategy for generating income. Without the risk stack, Sarah might have been swept up by the low price and charm. With it, she uncovers the true long-term costs and potential headaches. The deal suddenly looks much riskier, prompting her to either negotiate a much lower price to offset these risks or walk away for a truly better opportunity. Understanding and meticulously evaluating these layers of risk is foundational to building long-term wealth through real estate. When you identify and avoid properties with hidden liabilities, you protect your capital. This safeguards your equity against unforeseen costs and ensures your property has the best chance of appreciating consistently. Avoiding high maintenance or poorly located properties means more predictable cash flow, less vacancy, and fewer unexpected expenses that can erode your returns. Ultimately, by strategically sidestepping risky assets, you build a resilient, high-performing portfolio that generates true financial stability and wealth over time, rather than tying up your money in assets that become liabilities. Don't let a seemingly attractive price or superficial charm blind you to the deeper realities of property ownership. Every house carries some degree of risk, but truly understanding what makes a property exceptionally risky is the mark of a smart buyer and a strategic investor. Adopt this mindset of critical analysis, use a framework like the property risk stack, and you'll make decisions that not only protect your initial investment, but propel you towards long-term wealth building through real estate. Your future financial stability depends on it.